Hello, knowledge seekers. In this episode of 20-Minute Books, we explore How to Make Money in Stocks, a powerful guide to building wealth through the stock market. Authored by entrepreneur, stockbroker, and writer William J. O'Neill, this book offers proven strategies for finding profitable stocks and steering clear of losses. Drawing on lessons from history, it teaches readers how to recognize specific patterns within shifting markets in order to achieve financial success. William J. O'Neill, the founder of the brokerage firm William O'Neill and Company Incorporated and creator of the popular Can Slim investment strategy, uses his extensive experience to help readers navigate the unpredictable nature of investing. His expertise also includes establishing the renowned business newspaper Investors Business Daily. How to Make Money in Stocks is perfect for first-time investors eager to start building their portfolios, seasoned traders looking to expand their skills with fresh insights, and anyone curious about understanding how the stock market truly works. How to Make Money in Stocks, a winning system in good times and bad. Introduction. Discover how to confidently invest in stocks and spot the next big winner. Does the very mention of the stock market fill you with dread? You're certainly not alone. Many of us feel uneasy at the thought of seeing hard-earned money evaporate overnight. Images of stinging economic fiascos, like the dot-com bust or the infamous crash of 1929, can leave aspiring investors hesitant and fearful. But here's the good news. Stock investing doesn't need to be a nerve-wracking gamble. Imagine having proven strategies at your fingertips, clear guidelines to pinpoint high-performing companies, and reliable ways to know exactly when to buy and sell. The secret isn't found in luck or guesswork. It lies in learning from past investors' triumphs and setbacks. Understanding the stock market's past allows you to recognize patterns and make informed choices. One standout pattern that seasoned investors swear by is known as the cup with handle. Imagine observing a stock whose price nudges upward, dips down to form a rounded base resembling a cup, and then slightly retreats again into a shallow decline, creating a modest handle. Spotting this chart formation can give you a signal to strike at just the right moment, setting you up for potentially outsized returns. But finding the right opportunities isn't solely about chart reading. It involves recognizing the traits that successful companies often share. What might technology giant Cisco Systems have in common with automotive heavyweight General Motors? They're both prime examples of stocks that surged ahead thanks to their innovative edge and solid fundamentals. Identify businesses with strong market positions, groundbreaking products, robust earnings growth, and forward-thinking leadership, and you could find yourself investing in tomorrow's superstars. Speaking of innovation, truly transformative businesses tend to leave competitors behind in the dust. They're the ones consistently introducing new products, expanding into fresh markets, or revolutionizing industries altogether. Take Apple, Netflix, or Amazon as outstanding examples. Each radically changed or created entirely new sectors, delivering rapid, sustained growth in shareholder value. Spotting those innovators early in their ascent can dramatically boost your portfolio's performance. Ultimately, successful investing isn't about avoiding risk entirely. It's about mitigating it using time-tested approaches. By mastering the proven patterns, selecting stocks thoughtfully, and keeping an eye on innovation, you too can navigate the market with confidence and clarity, laying the groundwork for significant gains rather than painful losses. Part 1. Mastering a powerful stock chart pattern could boost your investing returns. A curious truth about human behavior is that history often repeats itself. This wisdom doesn't just apply to fashion or politics, it holds remarkably true for the stock market as well. Looking back across decades, through booms and busts, there's a consistent lesson that old stock market patterns come up again and again. And investors who recognize those patterns early can capitalize on golden opportunities. Think about doctors carefully examining medical scans before deciding on treatment, or geologists analyzing seismic charts to predict earthquakes or discover oil. Similarly, investors can use stock charts to uncover patterns that hint at future price movements, empowering them to make informed, profitable decisions. To genuinely grasp what the market is telling us, you must pay close attention to stock price charts. Although there are many types of patterns, triangles, flags, and double tops among others, there's one standout formation seasoned investors trust deeply. It's called the cup with handle. Picture this scenario clearly. Initially, a stock's price rises, exciting investors and attracting attention. But soon, setbacks occur, causing the price to decline gradually, forming a smooth downward curve, almost like the bottom edge of a teacup. Eventually, the price settles into a steady range, building a stable base. This crucial phase suggests that serious investors remain committed to the stock, holding steady despite troubling times. With this firm foundation, the stock price starts rising once again, moving smoothly upward, creating the other side of our cup. Then, just as optimism returns, the stock dips slightly, creating a small downward drift. This is your handle. Recognizing this gentle retracement is critical, as this precise moment is typically your best signal to invest. History underscores this phenomenon repeatedly. From sea containers in the 1970s to Apple in the 2000s, countless companies displaying this cup with handle chart pattern have rewarded well-informed, patient investors with spectacular gains. It's no coincidence. It's a proven chart pattern that reveals market psychology, indicating the optimism and resolve waiting to soar once again. While no method guarantees absolute success, becoming skillful at identifying the cup with handle pattern significantly improves your odds. So start studying, watch for the telltale signs in price charts, and when you see this familiar shape form again, you'll know exactly when it's time to invest confidently for substantial returns. Part 2. Companies with soaring earnings can supercharge your investment returns. Think for a moment about what makes any business truly successful: consistently increasing profits. No matter the industry, whether it's technology, healthcare, or retail, rising earnings typically lead to one inevitable result: a climbing stock price. So if your goal is to pick winning investments, aim your sights squarely at companies showcasing strong, sustained earnings growth. Investor history gives us powerful examples of how clearly earnings growth impacts share prices. Consider tech giants like Google and Apple, both of which offer excellent case studies. Google debuted on the stock market in 2004 at $85 and surged above $700 within 3 short years. Apple, likewise, soared from a modest $12 per share to over $200 in under 4 years. What fueled these explosive journeys? Significant jumps in their earnings just before their stocks took flight. Leading up to Google's exceptional performance, the company enjoyed incredible earnings growth rates: 112% one quarter, then 123% the next, sending clear signals to investors that something remarkable was brewing. Likewise, Apple's stock skyrocketed on the back of an astonishing 350% earnings increase, surprising even the most optimistic investors. But be careful. There's a trap investors must avoid: getting caught up in hype. In the late 1990s dot-com bubble, wild enthusiasm led investors to eagerly pour money into companies with massive promises but little to no actual earnings. When reality ultimately struck, investors who relied on optimism alone faced devastating losses. Yet firms with tangible, substantial profits, such as Yahoo and AOL, weathered the storm much better. This episode underscores why it's a smart strategy to stick to companies showing real and measurable earnings growth. So, how do you accurately identify promising businesses with strong, expanding profits? A simple yet indispensable indicator is earnings per share, commonly known as EPS. EPS demonstrates what portion of a company's profit goes toward each individual stock. To calculate it, you take the company's after-tax profit for a period and divide it by the number of outstanding shares. Your goal should be to find stocks posting reliably high EPS growth quarter after quarter and year after year. While rising EPS alone doesn't guarantee a winner, it unquestionably increases your odds of investing success. Earnings growth should be your foundational consideration, though later we'll explore other important factors to refine your stock picking skills. For now, keep this crucial guideline clearly in mind. Prioritize companies that deliver steadily improving earnings per share. By doing so, you'll put yourself ahead of investors relying on rumor or speculation, positioning your portfolio for substantial long-term gains. Part 3. Investing in groundbreaking companies can bring huge rewards. But timing is everything. Innovation is at the heart of human progress, transforming entire industries and reshaping our way of life. Throughout history, major advances, be it the electric light bulb or the smartphone, have driven exceptional growth in companies pioneering these leaps. And for those who invest wisely, such explosive growth has regularly translated into extraordinary stock market returns. Think back over the past century. Northern Pacific connected east to west with the first transcontinental railway, lifting its shares by an incredible 4,000% in just 2 short years after 1900. General Motors revolutionized transportation with their novel automobiles, propelling their stock up 1,368% over a span of just 1 year in 1913. And Cisco Systems dominated the networking landscape, connecting businesses globally, sending shares soaring an astonishing 75,000% through the boom years of the 1990s. The critical factor linking these impressive stock rises is clear: groundbreaking innovation. Great stocks and genuine innovation consistently move in tandem. Yet here's the catch. In recognizing an innovative company, identifying the right moment to invest is equally crucial. Traditional investing advice suggests buying low and selling high, but with true leaders of innovation, this wisdom doesn't always apply. Instead, extraordinary growth companies often seem overvalued early on, since their stocks rapidly reach new highs. But don't simply steer clear. Often these stocks break multiple new highs in succession, far beyond conventional expectations, making them winners that momentum can continue to push higher. Returning to Cisco's remarkable rise, by 1990, the company's stock had already hit new record levels. Investors who bought then were richly rewarded as Cisco continued setting new highs for years afterward. Analysis from Investors Business Daily has consistently shown that rising stocks tend to keep rising, whereas stocks spiraling downward usually continue their descent. So don't shy away simply because shares look pricey at first glance. Of course, that doesn't mean investing impulsively. There's an optimal moment to step into innovative stocks. The powerful cup with handle chart pattern we've discussed previously signals precisely such a moment. A stock surges, forms a rounded cup as it consolidates, and a smaller retracement creates the handle. Spotting this precise point frequently precedes powerful upward momentum that could reward investors substantially. Rest assured, America's spirit of innovation promises fresh opportunities. If you missed Microsoft or Apple, don't worry. New innovators continue emerging from every corner. Your job is to carefully identify these companies as their stocks prepare for breakout moves. By staying attentive, considering groundbreaking businesses seriously, and patiently awaiting the right opportunity, you're positioning yourself to enjoy the remarkable returns that accompany genuine innovation. Part 4. Understanding supply and demand can help you choose better performing stocks. Think about your everyday purchases. Whether it's toothpaste, groceries, or your favorite brand of clothing, prices fluctuate according to how much people want something and how much of it is available. This universal principle of supply and demand doesn't only determine consumer goods prices, it also profoundly impacts the stock market. Let's look closer. Suppose you're comparing two stocks, one from a huge corporation with billions of shares outstanding, and another from a smaller firm with fewer shares. To significantly move the share price of the larger company, an enormous wave of buyers would be necessary. It requires tremendous volume to shift that needle. On the other hand, for a smaller company with fewer shares available, even moderate buying enthusiasm can quickly send its stock price soaring. While this makes small-cap stocks exciting investments with potential for explosive returns, Don't forget there's a flip side. They're prone to equally dramatic downward swings when markets stall. Conversely, larger companies, due to their massive number of shares, tend to weather ups and downs with greater stability, offering steadier, yet generally more modest returns. But when you're analyzing supply and demand, it's not just the number of shares that matters, it's also crucial to look at who owns them. Companies where executives and leaders hold a meaningful stake are often set up for success. Why? Because when management has skin in the game, their interests align directly with shareholders. In large companies, look for executives holding roughly 1 to 3% of the overall shares. With smaller companies, leadership ownership should ideally be even higher. Such ownership indicates a strong commitment to growth and careful management, translating into a potential winner for investors. Another indicator worth considering is whether a company buys back its own shares. Share buybacks reduce the supply of available stocks and typically reflect the management's confidence in the company's future. Simply put, when a business repurchases its stock, it signals they believe the share price may rise, driven by improving profitability, exactly what investors like to hear. So as you evaluate potential investments, always keep supply and demand dynamics firmly in mind. Identify companies with fewer shares outstanding if you're seeking explosive growth, being mindful of the heightened volatility involved. Alternatively, larger companies may provide less flashy but more consistent returns. Most importantly, seek leadership teams who own a significant stake and companies engaging in share buybacks. Mastering the subtle yet powerful effects of supply and demand can help you become a more confident, strategic, and ultimately successful investor. Part 5. Focus on investing in dynamic industry leaders rather than sentimental favorites. Many investors gravitate automatically toward familiar brands, the comforting companies whose products they know and love, such as Coca-Cola or Nike. While there's a certain comfort in investing in these beloved businesses, sticking with what's familiar isn't always the best strategy. Why? Because in a strong, thriving bull market, emerging industry leaders frequently surpass these tried and true names, generating substantially higher returns. When selecting stocks, your priority should center on clear, innovative industry leaders. But what exactly defines a leader in this context? It's not necessarily the company with the largest market cap or the most recognizable logo. Rather, it's the business setting the pace in terms of earnings growth, robust sales figures, profitability, and consistently impressive return on equity. Most importantly, these top performers typically offer innovative, breakthrough products or services that excite customers and reshape their markets. History has repeatedly demonstrated the wisdom of investing in true leaders. Over the decades, the author's most profitable investments have consistently been dominant firms, companies notably ahead in their specific sectors. From Pick and Save's massive climb in the late 1970s, Amgen's surge in biotech from 1990 to 1991, AOL transforming the early internet landscape in the late 1990s, eBay revolutionizing online commerce between 2002 and 2004, to Apple's groundbreaking innovations from 2004 to 2007, each of these stellar stocks held top positions within their industries. By contrast, trusting sentimental favorites can disappoint. Consider the computer sector during the roaring bull market of 1979 and 1980. Ambitious newcomers like Wang Labs, DataPoint, and Tandy surged dramatically, multiplying many times in value. In contrast, seemingly dependable names like IBM or Burroughs barely budged. The fact that these older companies had once been reliable performers did little to secure them a position among that market's growth superstars. Similarly, avoid investing in copycat or second-best companies, hoping they'll somehow benefit from association with the frontrunner. Often, investors mistakenly believe these second-rate companies might share in the leader's success. Instead, the leading innovator almost always comes out ahead, by a significant margin. As industrialist Andrew Carnegie famously put it, the first man gets the oyster, the second, the shell. True market power and significant returns come primarily to first movers who introduce revolutionary products and dominate their industry niches. In short, when looking at the market, your aim should not merely be comfortable brands or lower priced lookalikes. Instead, always identify and choose dynamic companies that stand apart in earnings growth, innovation, and industry leadership. Ultimately, placing your bets on these genuine market leaders will position you far better to enjoy consistent and substantial investment success. Part 6. Boost your investing success by tracking where the institutions put their money. In today's investing landscape, mutual funds, pension funds, hedge funds, and other big institutional investors make up a huge portion of the stock market. These powerful groups manage vast fortunes, moving markets and driving the rise or fall of stock prices. With all this money under their control, wouldn't it make sense to pay close attention to the kinds of stocks they're choosing? As an investor, keeping tabs on the stocks that professional fund managers prefer gives you a clearer picture of strong investment opportunities. After all, institutions pour countless hours and resources into finding promising stocks. If these financial experts buy into a company, it likely means there's something special about it, whether in its growth potential, its fundamental strength, or its innovative leadership. But not all institutional choices are created equal. What you're really looking for are the best performing funds, those consistently generating impressive returns year after year. Financial resources and websites such as Morningstar.com and Investors Business Daily provide rankings, statistics, and details about top performing mutual funds. These websites even list the individual stocks included in these powerful funds, giving you invaluable clues about which companies may be poised to break out in the market. It's also important to pay attention to general institutional buying trends. Often, multiple large funds purchasing shares in a single company can create enormous buying pressure, pushing its stock prices higher. Simply put, heavy institutional interest can work in your favor, helping your investment ride a wave of rising popularity and value. Still, there's another layer to consider: knowing the philosophy behind how these institutions select their investing targets. Each mutual fund openly publishes this information in a document called the prospectus. Within this publication, you'll discover insights into the fund manager's approaches, strategies, and techniques, which can be incredibly useful for refining your own investment process. However, there's one important caution to keep in mind: beware of over-owned stocks. Just because many institutional investors hold shares in a particular company, that doesn't always mean it's a great investment. During the 1970s, for example, Xerox was a widely favored stock among institutional investors. This initially made sense. It had an exceptional track record. But beneath the surface, problems were brewing. Savvy analysts who took the extra step of closely examining the fundamentals saw the warning signs early, and when weaknesses became evident, Xerox's stock plummeted. The key takeaway? Institutional sponsorship is a valuable clue pointing towards stable companies with legitimate potential, but it's never a guarantee. By all means, pay careful attention to what the pros are buying. But ultimately, your own thoughtful analysis, thorough research, and due diligence will serve as your best tools for success in the stock market. Part 7. Watching the overall market closely gives you an edge in protecting your profits. Imagine carefully picking a stock that seems absolutely perfect, well-established, rapidly growing, solidly profitable. You invest confidently, but soon after, the whole market starts tumbling downward. Unfortunately, no matter how brilliant your stock pick was, the reality remains: when the tide retreats, most boats get left stranded. Indeed, during significant downturns, roughly 3 out of 4 stocks drop in value, no matter how sound and attractive their fundamentals might initially appear. Remember the financial crisis of 2008? Even the best investments suffered drastically if investors didn't step aside in time. Such moments illustrate vividly that understanding broader market trends is just as critical as choosing individual stocks wisely. So how can you gauge whether the stock market's mood is upbeat or if storm clouds are gathering. Thankfully, tracking tools are readily available. By monitoring key market indices such as the Dow Jones Industrial Average, Nasdaq Composite, or Standard & Poor's 500, all easily accessible online, you can quickly get a sense of the market's direction. Further, insightful metrics like the accumulation distribution scale, available through helpful resources such as Investors Business Daily, reveal whether large investors are predominantly buying or selling. Essentially, high accumulation signals investor confidence and buying trends, while heavy distribution shows investor fear and selling momentum. Such measures can offer an invaluable early warning of market shifts. By checking these indicators regularly, even subtle shifts won't escape your attention. Market sentiment often changes swiftly, in mere weeks or even days. Catching early signs is vital. For instance, if stocks repeatedly start the day high, but fall and end low, it can indicate weakening market momentum, a possible signal of a coming downturn or bear market. Conversely, a market beginning with worries and lows but consistently recovering to close higher may signal budding investor optimism and a developing bullish trend. Simply put, paying consistent, careful attention to the overall market is far more reliable than following analysts' inconsistent opinions or subscribing to costly, contradictory newsletters. Often widely promoted expert advice only muddies the waters. Just as a wildlife researcher learns more from watching animals directly in their habitat than from stacks of textbooks, you too will benefit most by directly observing market behavior and day-to-day index movements. Treat your investing practice like observing nature in action. Watch the market as it lives and breathes, showing you near real-time signals of its mood. By getting attuned to these daily movements and understanding broader trends, you'll be able to respond proactively. Tracking the broader market offers you powerful insights to protect your profits, allowing you to step away safely when things look unsettled and to leap back in confidently when the conditions are favorable again. Final summary. Investing in stocks can seem intimidating, but if you arm yourself properly, there's no need for fear. The stock market isn't about guessing or getting lucky. Instead, your best ally is knowledge. Start by learning to decode the language of stock price charts. One powerful pattern to become familiar with is the cup with handle. This chart formation, a clear dip forming a rounded base, followed by a short slight retreat resembling a cup's handle, is frequently a sign that a stock is poised for sharp upward movement. But recognizing healthy chart patterns isn't enough. Successful investing calls for choosing fundamentally sound stocks with tangible advantages. Look for dynamic businesses leading in their industries, top companies that showcase impressive earnings growth, strong sales gains, wide profit margins, and robust returns on equity. Particularly compelling are innovative firms developing unique products or services that reshape their markets. These have historically delivered exceptional returns. On top of identifying sound fundamentals, observe what institutional investors, the heavy hitters, are buying. Mutual funds, pension plans, and hedge funds put massive resources behind their research. Following their lead can validate your choices, yet never rely solely on others. Always verify by doing your own careful analysis and due diligence. Institutional buying is a helpful signal, but only if you independently confirm it. Finally, never neglect to follow overall market trends closely. Keep watch on market indices like the Dow Jones, Nasdaq Composite, or the Standard & Poor's 500. Observing shifts like heavy distribution periods, selling, or accumulation periods, buying, can clue you into the mood of investors. When the market as a whole trends downward, even the best stock picks may struggle. Conversely, investing during bullish momentum can amplify your returns significantly. To sum it all up simply, become a student of charts, especially the cup with handle. Seek innovative industry leaders with growing earnings. Monitor where big institutions are putting their funds. And above all, always stay tuned to the bigger market picture. By consistently applying these strategies, you'll confidently build your path towards sustained success in the stock market. Thank you for joining me today on this journey of learning and discovery as we explored the insights of another thought provoking book in our growing library of knowledge. If you've enjoyed our time together, please take a moment to follow our podcast, give us a 5-star rating, and share 20-minute books with other knowledge seekers. Your support truly means a lot. Don't forget to join me again in the next episode, where we will delve into another enriching book. Until then, happy reading and happy listening.